All right, we'll go ahead and get started. In case people haven't met me, I'm Chris Featherstone. I'm one of the principals at Madison Park. Do we have any pilots? Do we have any pilots here? Just one in training? Okay, well, fortunately, you don't have to be a pilot to answer these questions. Any idea what the easiest part of flying an airplane is? Being a passenger is not a bad answer. Basically, once you get at altitude, flying the plane, it pretty much flies itself, right? You just set it and forget it, essentially. Any idea what the most important part of flying a plane is, though? That's not a bad answer. You know, the most important, I'm going to get back to that one in a second. The most important part of flying a plane is actually the planning, the knowing where you're going to fly, knowing all the information that you need to know about where you're flying, how you're doing it, what speed you're going. That's all the planning stuff. So Jim, getting back to your answer there, any idea what the hardest part of flying a plane is? Landing, right? Everybody knows landing. Well, the truth is getting my wife to fly with me is actually the hardest part. So I've landed many, many times. I've only had her fly with me a couple times. So that's by far the hardest. But the reason I give you that example is because for us, the investment thing seems like that's what we do most. For us, the biggest value added is the planning. And we've talked about that a lot up here, different ways to plan, different ways to add value. I don't want to say that the investment stuff is just kind of set it and forget it, because that's not how we run things anyhow. But we think we can do a lot more value added by the planning. And for a lot of people, we have done that as well. So as we transition into the business part of it tonight, I just wanted to give you a little snippet, and I had a question at the break about this. Everybody knows SEPs and IRAs, and most people have been part of a 401k. But for business owners, there's ways to kind of soup that up. So you can have a 401k, you can have a profit sharing plan with that, you can have something called a safe harbor with that. The long and short of it is, as an employee, we're used to being able to put $18,000 away into our 401k. That's great. As a business owner, if we did a SEP, we could do 15% of whatever our gross income is. If we're really smart, we can do a 401k and we can get up to $54,000. Right, Jim, this year? $54,000 this year is our limit? 54.5. 54.5 is how much we can actually put away, and that's through these different layers. Through your 18,000 in your deferral as an employee, it's the safe harbor, it's the profit sharing, it's all that stuff put together. You can put away up to $54,000. Now, I can tell you 10 years ago, we didn't have a single client. Nobody had any money to do anything. They were just honestly just trying to get by, if everybody remembers 2008 and 2009. Today, it's really a different story, and a lot of people are making a lot of money today, and they're starting to come around to say, hey, what do I do with this? I'm going to get hit with all these taxes. And by the way, all the tax laws have changed now, and I think I'm going to be part of the 5% that's going to get hit worse than the other 95%. So now there's this thing called the cash balance plan, which is kind of a souped up pension plan, essentially. And depending on income and some other things, you could potentially put hundreds of thousands of dollars away. Now, again, it's got to be based on your cash flow. But 10 years ago, that wasn't the case. Today, people are starting to come back around to that, and it's a pretty popular thing to say, I can put away more than $54,000. Maybe I can put another $50,000 or another $100,000 away. There are ways to do that. So as we talk about planning, that's one of the things that we can bring to the table as well. So I don't want to take a whole lot of time because we got Jim up here for another 3.5 hours. So I appreciate everybody. Does everybody have wine? Lisa, are you driving home? Okay. All right, good. I want to make sure. Everybody watch Lisa, make sure she doesn't get out of hand. So anyhow, with that, without further ado, here's your next session for the next 4 hours with Jim. Just kidding.
It will be credit.
This one will be a lot more fun.
College credit.
Well, and this one can go, no, it's good. You're good. So this one can go short and go long. So Andrew passed out some material. We won't jump into it unless you really want to. Some of the questions I've been getting has been on this 20% deduction. I'll talk about it here. I can go into a lot more detail if wanted. So we'll kind of just let sort of things go where they go, and I don't want to put you guys to sleep if I don't need to, but if there's things that I can provide more detail on and be helpful and it's informative for you, I can do that. So all right, Mr. Jeff, we can probably jump to the next one. All right, so we'll just hit it right off the bat. One of the things in the Tax Law Act was a provision to make the small businesses happy. And I don't mean that in any sort of tongue-in-cheek way, but we did all this planning, and we'll talk about it. We've got a new territorial tax system, a lower flat corporate tax rate. But what about the small business? What about the pass-throughs that we talked about, or flow-throughs? And this is what kind of came of all of that planning and conversation. That going forward, if I'm a small business owner and I'm potentially a sole proprietor, I'm a real estate investor, I have an interest in a partnership or an LLC, I have an interest in an S corporation, I potentially get benefited by this Section 199A deduction, and only tax people care about that. We'll just call it the 20% deduction. And some of this gets definitional. Like I said, I can really go into the details. I'll keep it high level, and we'll jump in as questions come up. But if I'm a business owner and I got qualified trade and business income, I potentially qualify for this deduction. Depending on what type of business I have, I may not qualify, or I may be limited. And so we'll jump into it a little bit more, but there's certain people that are not going to get full benefit, or certain businesses, and those are specified trade and businesses, and they're ones that involve performance of services. Not all services, but for a lot of services, those businesses won't qualify. I'm a CPA. My business is considered a specialized service. Trade or business involving investment or investment management. Sorry, Chris, Andrew, and Jeff, and Dan, I'm sorry. Your business falls into that. And this one I really like. This is something we'll see get litigated later. They added a third line, and this is straight in the rules. Trade or businesses whose principal asset is the reputation or skill or one or more of its employees or owners. Isn't that any business, right? Even, and maybe not. Maybe I'm completely sort of just creating widgets and that's all people care about. But I find that that definitional thing isn't helpful. I think that's just a future litigation for the IRS to argue. But basically, if you're performing services, you may get limited with some exceptions. If those services result in some sort of tangible product, there's a good chance you still won't fall under that definition. For instance, architects and engineers, they're creating something. IRS likes that. Congressmen like it. Senators like it. So they don't fall, even though they're performing services, they don't fall under that category. So this 20% deduction, it is on qualified business income, which that does not mean investment income, but it does weirdly mean REIT dividends and income on qualified publicly traded partnership income. And if you don't know what a REIT is, it is a real estate investment trust. They throw out dividends. You'll be able to do a calculation on your dividend you get from a REIT. And that's helpful because if you look at the rules here, they didn't specifically talk about real estate, but I think everybody's inferred that if a REIT qualifies, a rental real estate, other things are going to qualify. So it's I think most professionals' opinion that rental real estate will qualify. What it doesn't include is reasonable compensation paid to S corporation owners or guarantee payments paid to partners. All right, Jeff, next slide. So this is where we start to get into the minutia here, that there's limitations. And so it depends on what your income is. And there's really two limitations. One, there is an overall business income limitation, and then there's your overall income that the income that you report on your return that might be included in other things. So we're really looking at taxable income here, and if my taxable income is below $157,500, or if I'm marrying filing joint, $315,000, it doesn't matter what my business is, if it's specified or non-specified, I get to take advantage of that 20% deduction with no limitations. Easy one. I have taxable income in excess of $207,500, or if I'm married filing joint, $415,000. If I have a specified service, I can still take it, but I have limitations. It starts to phase out. I'm sorry, I should say that. I got my slides backwards. Andrew, I apologize. I think you guys probably have the right slides. I did this wrong. Up here, it should say no for specialized services, period. In this section, it should say yes for non-specified services, but with limitations. So I'll talk about it. The slides are a little backwards. So if I'm...
Find the right slide, Jim?
No, we're fine.
Okay.
So if I'm above this threshold, and I'm a specialized service, you might have to write down, it's no, I don't get it, period. If I'm not a specialized service, I get it, but I start having limitations. And some of these limitations come down here where we start talking about wage limitations and property limitations. So this is all part of the calculation. So if I go here, I should step back. Taxable income between $157,000 and $207,500. Taxable income for married filing jointly between the $315,000 and $415,000. The answer should be, say, yes for specified services, but with limitations, right? That's what it should be. And it should be yes for non-specified services and no limitations. So, all right, my slide didn't help. Clear as mud. You guys all understand it. We'll start taking the quiz. As we start to get in some of the limitations, right, we're talking about qualified business income, but we also are talking about wage limitations. And so in a lot of cases, you're going to be limited to 50% of the wages that you have in your business. And so I am a sole proprietor. I have no employees. You have no wage. You pay. So
That's your
total wages.
W-2
wages you pay to all employees. Now, they haven't specifically said this. So I have an S corporation. I am an employee and an owner of that S corporation. Should my wage count in that calculation? Haven't actually formally addressed that. Most people feel the answer is probably no, and that was the intent to say no, but they haven't addressed it. So we don't know for sure.
Jim, any kind of feel for a time frame when that will become clearer? Because a lot of folks are kind of up in the air about it.
They are up in the air. You know, the IRS has out what they want to handle on a priority basis. I would think by midsummer we start seeing some things that make that clear. I saw nothing that limited it. So my conversation and my recommendation at this point is I think it will be included, but there isn't anything to say that for sure. But so if we go back here, I have a sole proprietor. I have no wages. Man, that's not going to work very well if I'm falling into one of these limitation areas. But the IRS was nice to us, and if I said rental real estate qualifies, right? I may not have any wages. But they also threw in another limitation that says, okay, well, we'll give you an alternative to that 50% of wages. We'll say 25% of wages plus 2.5% of the unadjusted basis of qualified property of the trade or business. We start to get into tax speak here, but what that means is maybe I have a rental property and I'm going to have no wages that I pay, but I can take my original cost basis of that property. Maybe it's $400,000. I times it by that 2.5%, and that will be my limiting factor. So they tried to help us out a little bit and help out some of the taxpayers by changing these limitations.
What were these guidelines previously?
Didn't exist previously.
Not at all.
Not at all. This is brand new. This is brand new. And so this was a nice little chart here where you can start to go through. It's in your slides, right? Is the business a C corporation? Answer is yes. Oh, nothing. All right. Okay. That's easy. Is the business a C corporation? No. Does owner's taxable income exceed these thresholds? Yes. Oh, but A, it's a specified business. Okay, so yes. Does my threshold exceed this amount? Okay, I talked about it. The answer is no, right? So you can kind of see what happens here. You kind of have to run through the scenarios to see, am I going to qualify, and to what extent will I qualify? And in some cases, there's just going to be some people that just do not qualify and there's not a lot to do. But there's other people that are going to maybe be on the fence as they fall into some of these taxable income brackets, and they may go one way or may go the other. All right, Jeff.
Said there's a lot of ambiguity there, because what's a specified service? You don't know.
Would be a list of services that are.
So I can do this. I can go to the packet that I handed out. And this is what we know so far on page 4. We've got disqualified trader businesses. And they're actually referencing an old code, but they're saying it is things in health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services. And then again, I told you the principal asset is the reputation or skill of one or more employees. Any kind of consulting, it's probably not going to qualify. You're going to fall under that specified services. Yes?
So I guess the question is, you as an accountant,
Yep.
own your own building.
Yep.
Right? We'll go back to the 80s and doctors and lawyers.
Yep.
That's so back in the 80s. Can you run your business through, your income through your building, and come out with a qualifying income that allows for deduction?
Pretty common if I'm a small business owner that I own my own building and I potentially rent it to my business, right? That's a pretty common scenario. So in the sense that if I look at them as two distinct activities and I'm paying myself what I would say is a defendable rental amount, I can shift income over to this rental activity of the activity of renting it to my business, and I could have income that qualifies there. I cannot sort of artificially try to drag in consulting or performing services income and run it through the building ownership piece, right? I'm going to have to think about fair market value. What would third parties do? Maybe be aggressive there, but I can't necessarily, I'm a lawyer, I can't just run it through it and say it's all part of my rental practice or my rental activity. I can't do that. So that's clear, can't do that. Then I could say, well, I can pay myself a reasonable rental income. Maybe I take on more of the expenses in my law practice and I pay them. It's a triple net lease. I do different things. So I think there's areas where you can plan and try to shift, but there'll also be some limitations in trying to do that.
Might be a bad question. What's the intent of this? Why would they limit the type of?
Why would? Well, because you have to think about what are the things that they are trying to encourage. And what they're trying to encourage is the blue-collar type production, manufacturing.
But a service,
Yeah, I'll
philosophically.
Phil,
A service business hires employees or skills and
being a business owner that has a service business, I completely agree. And I think we can all agree that our economy has shifted to a service-based economy, right? But I'm sorry if I'm sounding political, I don't mean to sound political. I'm saying where this was shaped from. What we've encouraged and what this is intended to do is to encourage people that create something tangible. And that's why architects and engineers qualify, because they, even though they are providing a service, it ultimately ends up in a bridge, in a building, in something that's tangible. And that's what we're trying, that's what this provision is trying to encourage. And that's not any different from what we were doing with other provisions within the tax law prior to this. We had a DPAD deduction, the domestic production activities deduction. We were trying to encourage manufacturing and construction activities in the US. That hasn't changed. Now they've at least made this one better, that they're giving people that are in some of these service businesses a chance, right? An opportunity to benefit, but they are taking out the top end people and saying, we're going to cut you off at a certain point. And so if you're a really good litigating attorney, or and you make $1 million a year, they don't want to give you a benefit.
I think it's also important to note why the 20% exists for anyone to start with. And that was because they cut the C Corp tax rate down to 21%. And so if you're a pass-through entity, an S Corp or LLC, you're suddenly at a disadvantage because you're paying ordinary income tax rates. And so by taking this 20% deduction, they're trying to more or less equalize the tax burden so that not everyone's just running for their lawyer to switch over to a C Corp or vice versa in order to get the best tax situation for themselves.
Now, interestingly enough, if I was a C Corp under the old rules, I paid taxes on sort of these graduated tax brackets. But if you were a professional service corporation, like I will just tell you, my firm is a professional service corporation. A lot of law firms are. They paid a flat tax rate, which we have now at 21%, but it was at that point, it was 35%. So you'd go, okay, we have this 20% deduction where we're cutting off these service providers, but under the new law, if I now have a professional service corporation and in the past I was paying a flat 35%, I get the benefit of the new 21% at a flat rate. So what you may see people doing is thinking about, how am I structured, what sort of entity do I have, and am I doing the best thing from a tax standpoint? So those are opportunities and things that people are thinking about how I can maximize the new tax law to benefit me and take advantage of what's there. Yep. Chris? I think you did this already, right? You did it. So I think one of the planning opportunities that Chris sort of mentioned, and there was a segue here that he could move into, is, all right, so I'm close to that bracket. I'm somewhere between 315 and 415 of taxable income. Could I do something to change my situation? Well, maybe I could put a bunch of money away in a retirement plan, like a cash balance plan, get myself eligible for that 20% deduction, and also put money away for retirement. So maybe I can do two things that benefit me: putting money away for later and getting a tax benefit up front.
A lot of the problem is, let's say you're making $350,000 for the year, you're starting to get into that phase out period, in that 20% phase out. If you did a 401k, if you didn't have one before, or if that includes a 401k, you can add a cash balance onto that. But the sole purpose, obviously, it helps for saving for retirement, but also if your goal was to get under that $315,000 threshold where it doesn't matter anymore whether you're a service company or not, that's, again, one more way to artificially try and get yourself below that threshold, so that's not an issue.
All right, positive for everybody, all businesses. What we've had happen with the depreciation rules, with the implementation of the new tax law, the tax reform, is through 2022, I buy equipment, as long as it doesn't fall in, well, I'm going to say I buy equipment. Where we get into different areas is when we start talking about things that are real property or considered real property. I buy equipment, whether it's new, used, doesn't matter, it just has to be new to me. Doesn't matter what my income is for the year, I get to just write the whole thing off in year one. That's it. That's the rule. I don't even have to worry about any sort of depreciation tables, anything else. I got some formal reporting I have to do, but that's all I got to do. It's now allowed for new and used property. It's 100% as long as it was acquired after 9/27/17. So this is one of those things that actually went back into 17. So some people have already seen the benefit of this. After that 2022 passes and this starts phasing down graduatedly, that's not a word, but sorry. It's like a word. Yeah, we can edit this later. There is the code section 179, which we've always had, but what we've done now is increased it from 510,000 to $1 million, and we don't start phasing it out for purchases of total property until we've got to 2.5 million. And we've even expanded it a little bit to include things like roof improvements, HVAC improvements, security system improvements, and some other things that used to not actually qualify because they were considered real property. The downside of this versus that is there's an income limitation. There's no income limitation. So, and there's no threshold. I can only do a certain amount per year. There is. So everybody's going to be using bonus depreciation for the foreseeable future, at least through 2022, and then they'll run into these rules and start utilizing this section 179 after that starts changing.
This applies to all business assets?
This applies to all business assets with the exception when we start getting into things that could be considered real property, there may be a limitation there. But other than that, it qualifies. Heck, this qualifies if I bought, a washer for my rental property, right? That qualifies. I get to write the whole thing off.
So what is additional first year?
So what they call it is bonus depreciation. And what they're really saying is, normally I have an asset, I have to write it off over 5 or 7 or 10 or 15 years. What they're really saying, this is bonus depreciation, and what it is additional first year depreciation. It just happens to be that it's 100% of the cost. We've had this, and it was even true in 17 up until this point, where the additional first year depreciation was 50%, and then you wrote the rest of it off over 5 years. So it's just verbiage, I guess. Next one. All right, so went over a couple positive things. Now we can talk about a couple of negative things. So write-offs, right? So this event, well, I don't want to say anything. I don't want to tie anybody to the deductibility for tax purposes. But starting in 2018, the rule is businesses can write off 0% of their entertainment expenses. It used to be 50%. It is 0. So that's just, it is what it is. And there is some questions I'm happy to answer if people want to dive into the details. There are different repeals. There's different things that have been affected that if you have qualified transportation, fringe benefits. As an employer, I can no longer provide my employees parking benefits and deduct those for tax purposes if I don't want to include them in my employee's income. Now, if I want to deduct them for tax purposes, I could include them in my employee's income. I'm at a loss. I'm at a double-edged sword. I don't know what the answer is. For optics standpoint, we've decided that we will continue to pay for it, not tax our employees on it, and we just won't take the deduction for it. I don't know. We won't talk about bicycle commuting reimbursements unless somebody really cares. All right. Well, okay. You used to be able to get a tax-free fringe benefit for bicycle commuting. You can't anymore. We already talked about this repeal the exclusion for employer reimbursed moving expenses. We talked about that as part of the individual presentation. And then other changes to employee fringe benefits. You can offer people like service awards, length of service, other things. They're changing the deductibility on that. There used to also be a provision that would allow you to have a group meal and that group meal might have been for the benefit of the employer, and I could take 100% of that. So I had a working lunch. I brought in lunch. The employer paid for the whole thing. I took 100% of that deduction. Under the new rules, I'm now limited to 50% of that. It's going to fall under the rules for all meals. The only place that you can get 100% deduction is if you have some sort of Christmas party, summer picnic, some sort of activity like that for the benefit of you and all your employees and the whole company. But so every day is Christmas. You sell it. You know, it's true. If you look on the calendar, there's a National Something Day, right? Every day of the year.
It looks like they want to stimulate a lot of growth and employment, but not have fun when you get to work.
They don't want you to have fun. I mean, to be honest, they were targeting a lot of the tech companies here that actually have, like, you know, I work at Google, I can go to the kitchen, the cafeteria. Well, you know, Google is getting 100% write-off for that stuff, right? So that's a lot of what they were trying to target. Unfortunately, they've targeted some other things. And where I personally feel bad is there's certain professions that rely on entertaining is really part of that industry. So I think they're killing some people that are in those industries because I think that's crucial. Yes?
How would you classify that for a Christmas party or a bar mitzvah party? Or, I mean, how do you classify it?
So we jumping into like the accounting part, like where I put this in my chart of accounts? I oftentimes have, like, I don't know, sometimes we call it work social event, right? Sometimes we just throw it in with office expenses. Sometimes I create an account that says, you know, meals and entertainment, 100% deductible. I even put it right on the tax return. This is 100% deductible meals. It kind of doesn't matter, it's just the rule. The rule is what the rule is, and for those things you can deduct it at 100%.
As long as it includes 100% of employees?
Well, and I don't even know that it has to include, I think you're safe at 100%. Maybe you can get away with less. It has to be non-discriminatory. It's supposed to be for the benefit of everybody.
What if
Right.
you're your only employee, but you hire vendors? Like that's how I am.
You bring vendors?
I'm a sole employee, but
Yeah.
everybody that works for me are vendors.
So we're going to start to get into the gray area of tax law here. I'm going to turn off the mic and turn off the video for a second. I think the technical answer is you do some sort of entertainment event and you've got vendors there. If it's a meal, you can deduct 50% of it, but if it's entertainment, so if you're going to the Mariners game, renting a suite, doing any of those things, I think the answer is IRS would say it's 0% deductible. Well, that's true, right? There's no entertainment. Low blow, low blow.
If you feed them lunch in the suite, you can write it off.
You could write off the portion that is related to the food.
Yeah, actually, through over here.
So
Restaurant.
Transportation is
No rules, no change around mileage. Those rules are still the same.
The meals thing, service businesses like ours usually involves meeting with clients over a meal,
Yep.
right? Which typically has been a 50%.
And that rule has not changed. Still 50%. So change your entertainment to meals. Although if you do something extravagant, IRS can say you can't deduct it. It was too extravagant. But yeah. So anyway, sometimes I feel like the messenger a little, like I'm getting shot up here. But I don't. Yeah, we're done. I don't like a lot of the rules. But they are what they are. And frankly, if you actually look at like the account, like everything gets scored when they pass a law, and they say, well, this is going to cost us X. This is going to generate X amount of revenue. The scoring there is just tremendous on how much revenue it generates for doing away with a lot of those fringe benefits and entertainment expenses. I'm going to talk about this quickly because it could apply. You have to plan around it, but it's sort of limited. For 2 years, 2018 and 2019, you could get a tax credit just for offering sick time to your employees. And I bring that up because in Washington State, if you're a business owner and have employees, like you're forced to offer sick time. So you're already doing this. But but you're probably, I don't know what you're doing, but you're only required in Washington State, if you have a full-time employee, to offer them 52 hours a year or 6.5 days, right? But the IRS is giving you incentive to offer your employees up to 2 weeks. So if you wanted to change 6.5 into 10 days, the IRS is giving you a potential tax credit to pay half of those normal wages for the sick time that your employees use. But there is limitations. They had to be employed but for at least 1 year, and that employee had to have $72,000 or less of compensation in the prior year. So that's why I said I talk about it quickly, because it could apply, but there's limitations. So I should have probably started with this slide, because it talks about, okay, hey, we have a change in the corporate tax rate. We've got a 20% deduction for flow-through or sole proprietor type income. What should I do going forward, right? And so I'm going to just go, this is a really basic calculation, but I think it can give you some perspective on what does it mean under the new tax regime as you're thinking about what kind of entity that you have. So let's say I've got a C corporation and it earns $100,000 of income. It pays tax, a flat 21%, so $21,000 of tax. I then, as the shareholder, want that money in my pocket, so the corporation has to pay a dividend. I know sometimes it comes out in wages or other forms, but let's talk about this, the double taxation. I want it as a dividend. And so after I pay tax, I've got $79,000 that it can distribute out. And personally, when I receive that, assuming I'm in the sort of the highest tax bracket for qualified dividends, capital gains, I would, at 23.8%, I would pay tax of $18,802. So after tax, on $100,000 of income that C corporation earned, I'd have $60,198. Effectively, I would be paying tax at 39.8%. If instead I was an individual with $100,000 of income, the worst case, and I don't think it's a very likely case, but the worst case is I would be paying an effective rate of income tax on my income at 40.8%, which is a 37, that's the top tax bracket, 37%, and then for some reason that income would also be getting hit with 3.8% net. That's not likely, but there's some scenarios that could happen. But if 199A deduction applies, my 37% tax rate is effectively 29.6. That's the effect of that 20% deduction. So I bring up this slide that says, in an unlikely scenario, I could be paying 1% higher just by being an individual that has an S corporation, a partnership, LLC, or some sort of sole proprietorship, right? There's that aspect. I have not thrown in anything about self-employment taxes or other things. Those are other issues, so I haven't factored that in. But if I'm looking at that, I would say in almost every instance, if you're an individual that has a business or an investor in a business, and you want that money in your pocket ultimately, you're most likely still better off just having it be an S corporation, a partnership, or an LLC, or a sole proprietorship, or something besides a C corporation. So, all right. Other changes, I mentioned earlier, like corporate AMT completely gone away. We used to have this deduction, the domestic production activities deduction. That's gone away. It was 199D. Now we have 199A. It was expanded accounting method exceptions for small businesses, which means some businesses, once you get to certain income thresholds, depending on what type of business you are, you're forced to use the accrual method of accounting. They now are saying that if a business, now with this new rule, that if you've got less than 25 million in revenue, you can use the cash method. So it may simplify things for some businesses. Net operating losses are changing. You can no longer carry them back, and you can only use 80% when you carry them forward per year. There are some people that have activities that they do that they're, get involved with, and I will say they're a profit in, their intent is to make a profit. I have clients that write books, breed horses, do other things, and maybe they're not that profitable. And the IRS could always fight those things and say that they're hobbies. They've now brought in sort of a new regime that if you have business activity, and if you're married filing jointly, and you have losses that are $500,000 in excess of the gross revenue that business creates, under this new rule, the IRS is able to start limiting those losses in excess of those thresholds. So I'm happy to talk about more details. I'm just trying to hit them high level for now. There is limitations on interest expense deductions for non-small businesses. So these are people with over 25 million in receipts, where in most cases interest expense is going to be limited on its deductibility. And there's a 30% threshold. We can talk, if somebody wants some mechanics, I'm happy to talk about it. I'll just hit the highlight here. I'll just hit the bottom. There's a very technical thing from a tax standpoint. They got rid of the partnership technical termination rules. One of the main focuses of the whole tax legislation, right, not only was the reduction in the corporate tax rate, but the corporate shift from worldwide to the territorial tax system. And I'll give you the 5-second explanation to what that means to most people, not much. What does it mean to multinational corporations that have foreign subsidiaries? It means that foreign subsidiary can earn the income, pay the tax in whatever jurisdiction it's at, and when it sends the money back to the parent corporation in the US in the form of a dividend, that dividend is not taxed in the US, when previously it was taxed. So that's the change. Now it's interesting if you look, I think Andrew and Jeff and Chris can attest to this. There was a lot of earnings reports that came out that said all these corporations had all these earnings hits because of all these taxes. Well, because all these corporations had all this money sitting offshore for many, many years, so for 1 year only, whether they brought it back or not, they were all forced to pay tax on that money. But that money was taxed, don't worry, it was taxed at preferential rates. So they got it somewhere between 5 and 15%, depending on other factors. But that is one of the things that was most talked about. So I like to bring it up. It doesn't affect most people, but that was really the reason. So if you want to have some tax planning opportunities, have a U.S. corporation, move your stuff offshore with a foreign corporation to a low tax jurisdiction, worry about different base erosion and other calculations, but there's a way to maximize it, and the tax planning alone will wipe out any savings you get, but there is some opportunities there.
Do we get to go to the Cayman Islands?
If you'd like. So, going forward, I think there is some thoughts and so there is some thoughts and some things you can think about as far as what sort of entity you have for business and how you're organized, and sort of the interplay with that 20% deduction rules, and how it affects things, net investment income tax, passive activity losses, and other things that go in and affect that. So happy to jump into more detail, answer more questions, even if it's not directly related to this topic. Otherwise, I think that's the end of the presentation. What? Oh, yes.
It was a beautiful day, and then during rush hour, it rained cats and dogs. But you came anyway. Thank you for coming. Hopefully this was helpful. This is not meant to be exhaustive. Jim did a great job covering a lot of bases here. Let this be a conversation starter with your tax advisor, with us, with Jim, whatever works for you. But hopefully this was helpful in at least beginning to get our heads around this otherwise intimidating, massively complex, big change we've had in tax law. So thanks again for coming, and we'll see you soon. Oh.